we are going to look at a case study which will examine a survivorship policy that was started back in 2016. So we'll see how much this individual, or I should say this couple, has paid into their policy since starting, what the cash value is, and then what things look like moving forward, in addition to some loan scenarios. They're interested in taking income from their policy for a somewhat short period of time. They want to be able to bridge a gap from a couple years from now up until age 65. So we're going to look at some cool strategies regarding taking income from a policy. But what we'll begin with is the overall performance. So a little bit of details on the case. Here's what we've got. Policy started back in 2016. When the couple started, they were in their late 40s. The total funding from 2016 up until now, for the first 7 policy years, they're about to enter policy year 8, but for the first 7 years, was $385,000. So a little bit more than that. There's 385 and a couple hundred, but we just used a clean number for this example. You'll see the exact number on the actual illustration. A survivorship policy. So firstly, what a survivorship policy is. It is one policy on 2 individuals. The life insurance death benefit is not paid out until both individuals die. So if you're considering a policy on you or your spouse perhaps, and one of you pass and you say, hey, we do want the death benefit paid to the other or paid to each other, we like that life insurance protection, a survivorship policy might not be the best option. In addition to that, there are some other things to be aware of with survivorship policies. They can be a very, very attractive option for cash value. Because it's one policy on 2 individuals, the insurance expenses are naturally a little bit lower because the insurance company knows that there's a high likelihood that they're going to be able to hold on to the death benefit payout for a longer period of time because both people have to die before they pay out the claim. So they know they're going to hold on to the money longer, which does result in a little bit lower expenses. There's an advantage there, particularly if we're interested in cash value buildup. So that's good to be aware of. However, there's some other things we definitely want to be aware of. One is the MEC treatment. So if we look at a single life policy, we've got that initial MEC test, that MEC limit. What's another name for the MEC test? 7-pay test. What does that mean? The first 7 years of a life insurance policy, I cannot drop the death benefit, or I should say it's very rare that I'll be able to drop the death benefit without triggering a taxable event, a MEC. After the 7th year, and this is with a single life policy, after the 7th year, I can drop the death benefit without triggering a MEC. Very common to see individuals take a policy, take a lump sum, move it into a policy over a short period of time, and then eliminate the premium, cut the death benefit in year 8, and it works beautifully. Can't do that with a survivorship policy. You've got different MEC treatment. Wherever your initial MEC limit starts, for this particular case, this policy, their initial death benefit was right around $1.95 million, which gave them a MEC limit of a little bit more than $75,000. It was right around $80,000 or so. So what that means is they cannot drop the death benefit to an amount lower than that $1.95 million. Might have been closer to 1.9, but my point is, with a single life policy, if I say I want to stop funding altogether and I want to maximize my cash value, I can remove any term riders, I can consider a reduced paid up option, which eliminates the premium. There are levers I can pull on a single life policy to reduce expenses and maximize cash value. With a survivorship policy, levers are available, but I don't have the same freedom I would with a single life policy. My point is this. You might be attracted to the idea that the expenses are lower, which can beef up the cash value performance. However, a lot of times in having discussions with individuals, it's not the first option, or it's not an option at all we would recommend, just because we do have to be able to heavily fund the policy for a longer period of time in order to make sure we don't run into any kind of MEC issue down the road. So the MEC treatment is different. In this particular case, we don't want the death benefit to dip below about $1.95 million. Okay. Death benefit reduction. So if we reduce the death benefit like we would with a single life policy, that'll trigger a MEC. Specifically, if we reduce it to an amount lower than 1.95 million. Another thing, income. What's often the most efficient manner to take income from a life insurance policy? Withdraw up to my cost basis. A withdrawal is just like withdrawing money from a bank account or any account. Once I withdraw it, it's gone. Unlike a loan, when I borrow against a policy, I continue to earn dividends and interest. With withdrawals, that's not the case. Now, withdrawals have advantages when I'm taking income from a life insurance policy. However, a withdrawal will result in the death benefit reducing, which puts me at risk of a MEC occurring. Point is, when we are building out a policy, we want to make sure that if we're going with a survivorship policy, we're aware of all the obstacles, and not necessarily you, the potential policyholder, but the agent needs to know of what can happen with a survivorship policy, because we can run into issues with that down the road. But with all of that said, so that's some supplementary information. Options we're going to look at. Option A, growth. Option B, loans with income. So what we'll look at with growth is as follows. What does it look like if they make no payments from this point forward? What's it look like if they pay the minimum premium only? And then what does it look like if they make a one-time lump sum, making up for unused MEC space, and just throw a big old payment into the policy? You'll see exactly what that number is. And then B, what's it look like if they take loans until age 65? All right, let's take a look at some numbers here. What we've got, stop funding. So the premium in this particular policy is just under $7,300 per year. That's the annual minimum base premium. When they did start the policy, they front loaded it. There were a number of years they paid $75,000. That was the plan. However, as the years have passed, they've cooled off on their funding. We see that the total funding from day one has been $385,000. Their present cash value as of today is $420,000 and change. However, at the end of this policy year, once the dividends are applied, we'll see it hit just about $434,000. So at the end of policy year 7, there's my total gain, or their total gain, $48,000 and change by year 7. That is very attractive when you look at a cash value life insurance policy, considering the amount they've paid in. It's partly due to it being a survivorship policy, but really you'll see similar results in a single life policy if you're max funding it up front. They had, it was at least the first 3 years, if I recall correctly, where they max funded the policy. They're moving large sums of cash into it and then backed off on the funding a little bit. But total funding, $385,000, and this assumes here no payments are made ever to the policy. Now we've got that premium of, call it $7,300 per year, that is still due, but they're not paying it. The policy is paying for itself internally through the dividends and interest. Now what we did here, remember when we talked about the death benefit, not being able to reduce it? Well, we cannot reduce it below what dollar figure? Just about 1.95. It's actually a little bit lower than that, but I do like to run things conservative. So what we did was carve off a chunk of term insurance, close to about $400,000. That did remove the bulk of the term insurance rider that was still attached to the policy. If they say, I don't want to pay anything anymore, this is a good option to consider. Reduces expenses and allows the cash value to grow at a faster pace. And as the death benefit comes down a little bit, never comes near the 1.95. And then begins to increase over time too. And there's the total gain. This is based on the present dividend interest rate. Things will change over time, but as the years pass, we want to continue to track the performance. And what we've seen is when we've got a well-designed policy, meaning minimum expenses, with one of the major mutuals, we've seen them deliver, which is fantastic. So let's take a look at paying the minimum premium. So in this scenario, what do we got? Exact same thing. And what do you see in year 7 when you compare these two? Year 7, there's nothing paid here because they've already paid the premium. That's why their total funding in year 7 is at $385,000. That's years 1 through 7, what they've paid in. So at the end of policy year 7, There's their cash value and death benefit. It's identical to the stop funding scenario because that premium's already been paid. The difference is this: beginning year 8, there's your premium of about $7,300. I'm adding more money to the policy. Now, what happens when I look at the policy performance here? Well, it increases by what I pay into it and a little bit more. This is a premium payment. There's no PUAs in this $7,500. Premium payments, especially beyond the first 2 years, begin to do what? Do they just purely satisfy the cost of the death benefit? No, they begin to come back to cash value. Especially in a policy like this that's entering year 8, we're seeing that base premium come back to cash value and some when we factor in dividends and such. My point is, I see those payments build value. And I'll add this: when they had originally started the policy, their plan was not to continue to make premium payments. In a recent review meeting about a week or 2 ago, they did state, the wife is primarily who I've worked with, she did say that she'd like to continue to pay the premium. So we're looking at a scenario here now where she can keep on paying the premium. And here's one thing I'll add: she doesn't have to pick one or the other. With this survivorship policy, that premium is due forever in this scenario. She's just not paying it. So she can elect to pay it some years, then stop, then resume. Maybe she scales the payment up. We did build in a lot of flexibility here, so she can increase her payments as time passes. You'll notice here, we did not decrease the death benefit by a large amount in year 8. We could, but we did not here. By keeping that term rider, she can throw more money into the policy. Again, you don't have to remember all of those details, but my point is she does have that flexibility to add more money to the policy if she wants to. Let's look at a large catch-up payment. Now this one we didn't really discuss. I just thought it was pretty cool. She did ask, what's the largest payment I can make without triggering a MEC, which is where the idea came from. But we just looked at all of the rollover MEC space because her original MEC limit was a little bit more than 75K. I believe it was right around 80,000. But with all of the unused space, it's just over $250,000 she could add. So we illustrated 250. Make a big old deposit into the policy, brings your total funding up to 635, and then just let it ride. Now this will look very attractive because you added a lot more money in. That's a $250,000 payment we just throw right on into the policy. So this is always fun to look at because I see the different growth models and I know that I've got flexibility where I can adjust the funding as time passes. This just displays different scenarios, different what-if scenarios. What if they decide to take some loans? So, taking loans, she did state that she would like to continue to pay the premium, which is important to add because personally, when we're modeling income from a policy, I do like to stop premium payments. And the reason why is because most individuals, when they're taking income from a policy, don't want to keep on making payments. Feels like it's counterproductive. Why would I give the insurance company money when I'm taking money? Like, it doesn't make sense. Can I just take a flat dollar amount? The answer is yes, you can. However, during the discussion, she did say, yeah, show me what it looks like if I keep on making premium payments. We've looked at stopping premium payments before. Okay, so here we go. On the left, this just displays what we looked at, continuing to pay the premium, and we see what the growth looks like. Over here, you've got the $80,000 loans. So we've got the funding continuing, but then after the 10th year, starting at age 59, we've got 7 $80,000 loans coming out. So these are loans they're taking for income for themselves through the age of 65. That's what we wanted to model here. At the same time, the premium is being paid. Now, what happens to the loan balance here? It's growing by more than $80,000. And the reason why is because we're taking loans and letting that loan interest ride. We are not assuming we make loan interest payments here. We're going to look at something that does address that loan interest partially next. But here, what do we got? The loan interest continues to compound because the balance is growing. And what happens? cash value continues to increase, which is what we want to see. This does display the net cash value. The same is true of the death benefit. It's the net death benefit, meaning net of the outstanding loan, here's the cash value you have access to. Net of the outstanding loan, here's the death benefit that will still be paid out upon the death of both of the individuals because it is a survivorship policy. But here's really what I want to hit on. So here, after they take the loans, we left about $100,000 in cash value. They could take more money out because there's cash value in there. But here's what I like to look at. This is a non-direct recognition policy, which makes it simple. We're earning dividends on your entire cash value, any money outstanding in loans and what your cash value is. Okay, that's great. What I want to make sure of is that the growth on the policy, the earnings rate, the dollars I'm receiving from the insurance company are always exceeding the loan interest that is being charged. Because the issue that can happen is something like this. What happens to your cash value? It starts to go down. Why would that happen? Well, that happens if the loan interest on the policy exceeds the total earnings. So once it begins to exceed the total earnings, I see my value start to go south. And what can happen, which gets really dangerous here, is it begins to call for more money. Now this happens in their late 90s, but it also happens in their late 90s based on the present dividend rate and the present loan interest rate, which is variable. So something we might do here is look at a conservative dividend and a more aggressive loan interest rate to see if this happens earlier. We might want to look at a different solution here. Maybe we redirect some of this premium payment toward the loan, or maybe we apply some of the dividends toward the loan interest. I want to avoid this from happening where it calls for more money. If I can't pay it, it can lapse, and with a large loan balance, that can trigger an ugly, ugly taxable event. So with all of that said, what we can look at here is paying the loan interest. So this was a lot of fun. What we did here is fund the policy while we are taking loans. So we've got $80,000 loans through age 65. There's my loan balance. What happens the next year though? We stopped the annual funding and took that $7,300 per year we were paying toward the premium and just started applying it toward the loan balance. So what we did is basically turn this into the stop payment scenario. So now we're not paying anything toward premium or PUA, and then just take the money we were paying and apply it toward the loan. And the loan interest is greater than the amount we're paying, but what it does is slow the balance down. And really what it prevents is when we scroll down, we don't see a case where it calls for more money, or it implodes, or that cash value gets dangerously low. It does start to go down here, which we still want to prevent that from happening, and seeing this up front allows us to have awareness. Transparency is important, but this option is much safer in my opinion as we compare the two side by side. And then we looked at one where we stopped the funding altogether. Go up a bit. There we go. Stop the funding, take loans for a bit longer, because what we did was pay the loan interest indefinitely, which I'm not sure that they would want to do that because they stopped funding and they're taking income, so making large loan interest payments may be counterproductive. In any event, I do hope that you enjoyed this video. I had a lot of fun putting this case together because I like looking at this kind of stuff. But if you did enjoy it, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much.
Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.